Accounting for Leases, Part 3. If you haven't yet done so, please read pages 873 to 873 in your textbook before completing Part 3 of this Accounting for Leases handout. Let's begin. In the last video concerning leases, I used the term a direct financing type lease versus a sales type lease. When you have a lessor offering a lease to a lessee, they can be one of two types. They can be offering a direct financing lease or a sales type lease. In a direct financing lease, they're really just acting as an underwriter for the loan, and it was the example that we had shown in a previous video. You can perhaps relate to this if you use credit unions to finance leases. You could buy a car at a local dealership and finance it, the lease, through your credit union. You would go to your credit union, tell them you want to lease a car. They would go and they would purchase a car, maybe not directly and pick it up for you, but they would deliver a check to the dealership and pay for the car, and then they would turn around and sell that to you. But they wouldn't be selling you the car, they'd really just be offering you the loan. In a sales type lease, that's when a lessor actually sells you a product and is just using the lease as an alternative source of financing. An example you could probably relate to is when you go to a dealership and you lease a car directly from them. There's no one else involved. They carry the paper for you, and they're simply offering another way to sell a car to you. They'll sell it to you for cash, they'll sell it to you on a notes payable, and they'll lease it to you, making another option available to you. Well, I would like to show you how a sales type lease changes our example. Assume the same set of facts as above. We still have our $15,000 piece of equipment, but now we're not just carrying the paper on that being a direct financer. It's a sales type lease that we make that piece of equipment and that the cost of that piece of equipment to us was $4,000. Or maybe we just wholesale it or retail it. We're a merchandiser and we're turning around and selling equipment. It can be either way. Let's calculate the gross profit on this sale and prepare the entry to record this sale so you can see how the accounting changes. First of all, we're going to record a sale on our books of $15,000, have a cost of goods sold of $11,000, and that would equal gross profit of $4,000. Let's see how our journal entry is affected by this. Recall we had a payment made on the first day, so we have a lease receivable of $95.17, and we receive cash of $54.83, and now we have a sale in that amount. We're also picking up the cost of goods sold and the inventory, so you can see where the sales comes from, and cost of goods sold is just another expense. So on our income statement for the period that we first initially sell this car in, we're going to pick up gross profit of $4,000. Now at the end of the year, we're still going to record our interest receivable and interest revenue from our amortization amortization schedule we made in our previous video, and if you recall, it was $952. So on our income statement, we'll also have some interest revenue if it's a sales type lease in the amount of $952. So in the first year, the income statement for a sales type of lease, you'll have two sources of income, the gross profit and the interest revenue. Compare that with a direct financing type lease where you would only have the $952. All other entries recording payments and depreciation would remain the same, so I'm not going to show you all of those again. but I am going to summarize by noting that in a sales type lease, the lessor or seller will have two types of income in that first year: gross profit in the year of sale and interest revenue in the year of sale, but will have interest revenue in all subsequent years as well. In a direct financing type of lease, the lessor will only have interest revenue. Thanks for joining me, and we'll talk to you soon.